Building wealth doesn't require day trading or watching financial charts like a hawk. The most reliable way to grow it involves doing almost nothing at all. Today, we are going to build a fully automated, diversified investing system. Once you set it up, which takes about 5 minutes, it runs entirely in the background. Before you invest a single dollar, you need a foundation. That means a reliable income, a clear monthly budget, and an emergency fund covering 3 to 6 months of expenses. If you don't have those yet, pause the video and focus on that first. Money needed in the next 3 years for emergencies belongs in a high-yield savings account, where principal is protected. Only money you won't touch for at least 5 years goes into this automated system, ensuring you never sell at a loss if the market drops. Step 1 is choosing a platform. Open an account with a robo-advisor or a standard brokerage that offers automated investing. You are not going to pick individual stocks. Instead, you'll select a portfolio made entirely of low-cost index funds or ETFs. This spreads your money across thousands of different companies, instantly reducing your risk. During setup, the platform will ask you to set your risk tolerance. You'll use a slider to choose a mix, adjusting the balance between higher return, aggressive stocks and lower return, conservative bonds. It is tempting to drag that slider all the way to maximum aggression to chase the highest possible returns. But a 100% stock portfolio comes with steep market drops that test your nerves. Financial author Morgan Housel calls this aiming for reasonable rather than rational. A mathematically optimal portfolio is useless if a market crash causes you to panic and sell everything. Picking a slightly less aggressive mix that lets you sleep at night is the strategy you will actually stick with for decades. Now that you have a portfolio, you need to decide which account to fund first. The sequence matters because of taxes. First, direct your automated contributions to your employer's 401k, but only up to the employer match limit. That match is guaranteed money, and you should always take it. Next, any additional money should spill over into tax-advantaged accounts, like a Roth IRA or health savings account, where your investments grow completely tax-free. Finally, if you max those out and still have money to invest, direct the remaining funds into a standard taxable brokerage account. Following this exact sequence protects your returns from taxes at every step. That means a much larger share of your compound growth stays in your pocket, rather than going to the IRS. Step 3 is setting the machine in motion. Link your checking account and schedule a recurring monthly transfer. Set the date for the day after your paycheck clears, so the money is invested before you have a chance to spend it. This recurring transfer is called dollar cost averaging. By investing the same dollar amount every month, regardless of what the market is doing, you automatically buy more shares when prices are low and fewer when prices are high. This is the exact opposite of trying to time the market, guessing when to buy in or pull out based on the news, which almost always results in mistimed trades. Setting a fixed schedule completely removes your emotions from the process. You don't have to read financial reports, check the news, or log in to trade. Over a long-term horizon, this steady, robotic consistency reliably beats market timing because it capitalizes on the market's natural volatility instead of running from it. Step 4 ensures the system maintains itself. Go into your settings, locate the Dividend Reinvestment Program, often called DRIP, and toggle it on. When the companies in your index funds pay out cash dividends, DRIP instantly uses that cash to buy more fractional shares of those same funds. Your portfolio feeds itself. Next, find and enable the feature called auto rebalancing. Over time, some of your assets will grow faster than others, shifting your risk level. Auto rebalancing detects this and automatically sells off your high-performing assets to buy more of the underperforming ones, pulling your portfolio right back to your target risk ratio. By flipping these two switches, your static account becomes a self-repairing, self-optimizing wealth machine. It buys, it balances, and it grows, all without a single click from you. Your paycheck hits your checking account, a scheduled transfer moves it to your portfolio, the algorithm buys a diversified basket of ETFs, and every dividend cycles right back into the system to buy more. The setup is complete. Ironically, the hardest part of this entire strategy is what comes next, resisting the urge to tinker with a working system. As Morgan Housel points out, good investing isn't necessarily about making brilliant decisions. It is about consistently not screwing up. The most powerful investment strategy in the world can be summed up in 4 words: shut up and wait. So delete the stock ticker apps from your phone. Stop checking your portfolio balance every day. Let the machine do its job, and let time do the heavy lifting of compounding your wealth.